breakout, not looking, it wasn't like it was an optical illusion. The thing was going up. You finally start to deflate some of the ongoing commodity inflation. And Powell took and Bullard, different people are saying, hey, look, it's time to go. And he looked like he learned from that mistake. He said, I'm not going to Jackson Hole in person. We're going to do it via Zoom. And he came in as dovish on the margin, as definitely more dovish than I or the market would have expected. And I think, to me, that's because he didn't want to do what he did in Q4 of 18. One, do you agree with that? And two, why would he do it? Why would he do it again in November, even though we both think that he will?
It's a really good question. There's sort of an institutional momentum. I mean, you look at the FOMC minutes. I've been in the boardroom down there. There's like 45 people in the room. It's not just the voting members of the FOMC. Like they got chairs all around the edges, and the whole table's filled up, and probably standing room only. So there are like 45, 50 people in the room, including some people I speak to. And so there's an enormous. Don't underestimate the power of consensus, the difficulty of being out of consensus if it's all leaning a certain way. The institutional bias, we don't have to get into the whole, behavioral psychology, cognitive bias thing, but they're using bad models. You use bad models, you get bad results every single time. They'll be very consistent that way. And fortunately, we haven't heard about the Phillips curve since Janet Yellen left, but there's still a part of them that thinks that declining unemployment rate has inflationary potential. That's what the Phillips curve says. It's empirically wrong, but lots of evidence for that, but they still stick to it. And they've got this residual fear of inflation, and there's just enough data, mostly base effects, mostly COVID bounce back. And Keith, you mentioned 40 different ways to think about inflation, and that's correct. And I'm not a big fan of what's called the trimmed mean. That's where I think the Dallas Fed does the trimmed mean. So they say, well, what would inflation be if we threw out the highest ones and the lowest ones? And to me, sometimes that's junk because, well, no, they're real. You can't just throw away the stuff you don't like. But if it's the case that the inflation is heavily concentrated in one or two subcategories, and they're not likely to be recurring, then the trim mean carries a little more weight with me than it might otherwise. And this is basically automobiles. And we started out with used cars because you couldn't get new cars, and now it's flipped over to new cars. And they're very hard to get. And the reason is not because they don't have any sheet metal or glass; it's because semiconductors. Your automobile is a computer on wheels. I mean, I learned to fix a carburetor with a screwdriver when I was stuck on the side of the road 40 years ago, but the cars don't have carburetors today. The point being, they're really heavily computerized. If you can't get semiconductors, you can't make cars. Well, that's easing up. But so much of the inflation is in just automobiles and one or two other things, but it's not broad-based. So if it's not broad-based and you can see kind of the end of the bottleneck, which you can, then you would not extrapolate that. And but they feel that institutionally they've had to respond to it. And I wrote a long article and kind of wrapped around Robert Shiller's book, Narrative Economics. And it's a great book. I highly recommend it. I used to recommend my own books. I still do, but I'll recommend that one. And narrative economics, I mean, I've always used it in one fashion or another. We call it anecdotal evidence or whatever. I've always put a lot of weight on it. Most mainstream economists do not because it's not highly empirical, but you can model it. And he actually took the epidemiology model, which we've all had to learn because of the COVID, and brought it over to economics, did a good job of that. Because the whole idea of infection, exponential functions and all that is all true. But the one thing I got out of that book was that I focused so much on being correct, getting your facts right, if you want to put it that way. He said narratives don't have to be true. A narrative, if enough people believe it, it can be completely false and it can drive markets. And I said, that's interesting because I'm always looking for facts. But what if the narrative is driving the market and the narrative is false? It doesn't matter. It still drives the market. So we've had this inflation narrative for about 6 or 8 months. And it's very powerful. It's taking stocks higher. And I think it's coming back to your point. It's influencing Fed behavior and Fed analysis. It's empirically false, but it doesn't matter because it's there. And it's going to take a 2x4 to the forehead to get them to change. But my concern is that they actually will start the taper in November. They'll be institutionally bound to continue it. The implications of reversing course are huge. So there'll be all kinds of institutional impediments, but it'll just be the wrong thing at the wrong time, as usual.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
The Fed proved that QE doesn't work. It was 2009 to 2020, average annual growth was 2.2%. That was the weakest recovery in U.S. history, weakest ever. The average recovery since 1980 has been about 3.2%, a full point higher. The average recovery since 1946 is about 4.5%, so double, okay? So that was the weakest recovery ever, significantly weaker than the post-World War II average, and a lot weaker than the post-1980 average, which is a pretty favorable period. But the Fed took the balance sheet from $800 billion to $4.5 trillion at the time. So increasing your balance sheet by a factor of 4, and all through QE, and you got the worst recovery ever. That proves that monetary policy doesn't work. It proves that QE doesn't work. And so if QE doesn't work and you're trying to tighten with tapering and you're already at zero, how exactly do you have the markets back? We saw a full dress rehearsal in 2018. We talked about that a little bit earlier. Now, to his credit, Jay Powell blundered badly, but after the Christmas Eve massacre, he literally came out the day after. Who works between Christmas and New Year's? But not very many people. But Powell did like a panel or something like that. He said, "Well, we're going to raise rates," and they did. And they did fast.
Yeah.
Or sorry, lower rates. I misspoke.
Yeah,
they raised them up to 2.25 or 2.5, and then they took them down really fast. So that was the pragmatic side of Jay Powell. But we're just at the beginning of this, and so they're going to do that. Now we can make it worse. A couple things. We talk about other factors, Keith, and exogenous factors and hedge funds blowing up, et cetera, and that is happening. There was a little segment. This is something I spent a lot of time on, but there's a little segment in the FOMC minutes from the July meeting about cryptocurrencies. Like, why is the Fed talking about cryptocurrencies? And it was very I don't know, intellectual. I don't know what it was. It was they were looking at stable coins. They didn't mention Tether by name, but they were looking at stable coins and saying, these stable coins, they have some of the characteristics of the money market because people put money into them and they think they can get it back at par, dollar for dollar. But what do the people who are running it do with the money? Well, they invest in other stuff. I mean, Tether's trying to be transparent, and they came out, they said, well, they're like, I forget the exact number, but it's very high percentage, like 2/3 or more, in commercial paper, as if we're supposed to feel comfortable with that. Well, okay, if the commercial paper issuer is, I don't know, Amazon, I take their credit, but commercial paper is, under the Uniform Commercial Code. It's just an unsecured IOU with a maturity of less than 365 days. So who's the issuer of the commercial paper? Is it an affiliate of Tether? Is it, where's the money? And we don't know. We don't know. But it's like, okay, you guys learned something from the money market collapse in 2008, maybe. But if you think that's the only problem with stablecoins, if you think that these are like a close analog to money markets, which at least have some SEC regulation, no, this is 10 or 100 times worse. And most of the money that goes into Bitcoin comes from Tether. People go to unregulated, they buy Tether, and then they use the Tether to buy the Bitcoin. 2/3 of the money going into Bitcoin is in Tether. Now it starts out as dollars, but the dollars go somewhere else. So you can't unwind this. You can't play this in reverse. So just put that to what the Fed mentioned it, but they have no comprehension as to how bad that can be, on top of everything else we're talking about. And then just to put a cherry on top of the ice cream soda here, is fiscal policy. Fiscal policy is impotent. I know we got a $3.5 trillion bill right around the corner, but the evidence is very good, very strong over decades, centuries, developed economies, developing economies, all economies, et cetera. And here, you look to Carmen Reinhart and Ken Rogoff, that when your debt to GDP ratio goes past 90%, your Keynesian multiplier goes below 1. Mm-hmm. Meaning, if you borrow $1 and spend $1, you don't even get $1 GDP. You get 90 cents or 80 cents, et cetera. And it's just diminishing marginal returns. It applies to all complex dynamics. So all the spending in the world will not grow. It will not stimulate the economy. I don't know, they call it stimulus. I don't call it stimulus. It's just so our debt to GDP ratio is now up around 130%. I said 90% was the threshold, and that's what the evidence shows. We're up around 130%. Who's at that lunch table in the cafeteria? Who's sitting at your lunch table? Lebanon, Greece, and Italy. There's your foretop, right? Okay, that's where the United States is. We always like to make fun of Spain and France because they're like socialists. Their debt to GDP ratios are much lower than ours. They have their own problems.
Yeah.
Don't get me wrong, but we're with Lebanon, Greece, and Italy. So so from the fiscal policy doesn't work for the reason I mentioned. Monetary policy